Hello everyone, welcome to BHU Swayam program on Fundamentals of Economics and Financial Markets. Myself, Dr. Anand Singh, and under this program, I will be discussing regarding the concepts of financial market. Now today I will be discussing with all of you regarding the concept of financial markets on 7 major key points. That means 7 key points will be discussed with all of you. Now, what are those key points? Point number 1. What is the meaning of the financial markets? Under this particular segment, we will discuss regarding what is the exact meaning of financial markets or how we can define a financial market. Now, in the second segment, we will discuss regarding the major components of financial markets. That means what are the major segments or what are the major parts of financial markets. That means overall there is financial market, but how many segments are there, how many components are there in the financial market, it will be discussed under the key point number 2. Now the key point number 3, it basically deals with or it basically discuss or it will basically cover regarding the maturity period, the concept of maturity period. Under this particular point, I will discuss with you regarding the maturity period. What is the meaning of maturity period? In absolute terms, what will be described or which period will be described as a maturity period for any financial instrument. Now, the key point number 4, it basically covers the meanings and concept of money market. Under that particular segment, we will discuss regarding the meaning of the money market and some of the important features which are basically associated with the Indian money market. Now, the fourth point or the fourth key point, it basically covers or it basically discusses regarding the meaning and concept of capital markets. Under that particular thing, we will describe regarding or we will discuss regarding what is the meaning of capital market and what is the important feature which is associated with the capital market. In the sixth segment, we will basically discuss regarding the meaning and concept of primary market. Under that particular segment, we will discuss regarding what is the meaning of primary market and what are the important features or key features which are basically associated with the primary market. And in the last segment of today's video, we will discuss regarding the meaning and concept of secondary markets. In that segment, we will discuss regarding the meaning of secondary market, what do you mean by secondary market, and what are the important features which are basically concerned with a secondary market. Now, let us move to the first point, that is the meaning of financial market. What is the meaning of a financial market? Here, financial markets are basically those markets which deals with the financial securities. Now, here it is clear that in the last video, I had already discussed that the financial securities, they are also known as financial assets or they are also known as financial instruments. That means financial assets, financial instruments and financial securities. All these three things are synonyms of each other. Now, that market which basically deals with or where buying and selling of financial assets or buying and selling of financial instruments or buying and selling of financial securities are going on, that particular market is known as financial markets. So, financial markets are basically those markets which provides a platform for the trading of financial assets or for the trading of financial instruments or for the trading of financial securities. Now, here you must be clear regarding one point. Financial markets basically deals with every kind of securities because we know that the financial securities, they are basically of two broad categories. They are basically of two different types, that is long-term securities and short-term securities. However, in many books, in many authors, many experts, they used to describe or they used to basically classify the financial assets into three major categories, that is short-term securities, medium-term securities and long-term securities. That is also true. That is also good. That is not irrelevant. But here we will differentiate or we will segment all the financial assets broadly into two major categories, that is long-term and short-term securities. Now, you must be clear that in financial markets, every kind of securities are being traded. That means whatever the nature of whatever the maturity period of the instrument is there, whether it is long-term security or whether it is a short-term security, but all kind of securities, all kind of assets or all kind of instruments, all kind of financial assets, they are basically traded in financial markets. So financial market is that market which deals with financial assets. And these financial assets might be of long-term nature, at the same time it might be of long-term nature. Now, who basically participates in such kind of markets? Now, the participants in the financial markets may be an individual in the form of any person like you and me. We are also authorized to participate in the financial market. The individual might be a company, a business firm. The companies, they are also permitted to participate in the financial market. In the same manner, the government is also there. The government is also permitted to participate in the financial market. Now, the buyers and sellers, they might be individual, at the same time they might be institutional. They might be the domestic investors, they might be the foreign investors. For example, we have heard about DIIs, FIIs, etc. So, what I mean to say that in the financial market, all the individuals, they are participating, all the institutions, they are also permitted to participate. At the same time, the government is also participating in the financial market. So the buyers and sellers, they might be individual, they might be institution, they might be domestic, they might be international bodies or institutions. So each and everyone is permitted to participate in the financial market, subject to the fulfillment of certain conditions or the conditions which are basically prescribed by the regulatory bodies, especially SEBI, Securities and Exchange Board of India. After fulfillment of the conditions which are prescribed by SEBI, all the individuals, institutions, organizations, or even the government, it is permitted to participate in the financial markets. Now, let us discuss regarding the key components of financial market. Now, our Indian financial market, it is broadly classified under two major segments. That is, number one, the first segment is money market and the second segment is known as capital market. So we can say that Indian financial markets, they are broadly classified under two major categories. That is, first category is money market and second category is capital market. Now, let us discuss regarding the concept of money market and the concept of capital market individually. Now, basically money market is that segment of financial market which deals with the short-term securities having a maturity period of less than 1 year period. Now, before discussing in detail about the money market, let us discuss about the concept of maturity period, because here all the securities, as per the definition in money market, all the instruments or all the securities which are traded, they are having a maturity period of less than 1 year period. Then we should understand or we should know about what is the concept of maturity period. When an instrument or when a security is said to be matured. Now let us discuss this particular topic with the help of an example. Now suppose I have deposited rupees 100 in a bank on a condition that the bank will give me an interest of rupees 10 on a monthly basis. That means I have submitted rupees 100 or I have deposited rupees 100 in the bank, and the rate of interest upon that 100 rupees is say 10 rupees, and the rate of interest is basically applicable on a monthly basis. And what I am doing, at the end of every month, I used to withdraw the interest amount. That means, suppose at the end of first month, rupees 10 was credited by the bank into my account and I just withdraw the interest amount. And what about the principal amount? It was carried forward to the next month. Now, in the next month, again also, I just withdraw the interest component and carry forward the principal amount. Now, what will be the maturity period here? Now, in this case, the maturity period is not clear, because the entire amount is not getting matured. I am only taking my interest component. I am just withdrawing the interest component, but I am not withdrawing the principal money. I am just carried forwarding, or I have still invested my principal money with the same institution, with the same financial institution. Now, then what is a maturity period? Maturity period indicates that period when both the figures, that means the principal money and interest thereupon, when both the figures will get matured, or when the investor is eligible to get both the figures, when the investor is eligible to withdraw both the figures at the same time. That means he is eligible to withdraw his principal money, that means the actual money which was invested by the investor with the institution or in any instrument, and at the same time he is eligible to withdraw the interest thereupon, that means interest which is applicable upon the instrument. When the investor is eligible to withdraw both the amount, that means the principal money and interest thereupon, then that specified period or that specific period at the point of which the investor is basically withdrawing his principal money plus interest thereupon, that period will be regarded as the maturity period. Let us take an example. Suppose I had invested rupees 1000 in a bank for a period of 1 year, and the rate of interest was applicable upon or which was applicable upon the investment, that was 10%. Now at the end of the 1 year, what I am eligible to take or what the investor is eligible to withdraw, his principal money, that is rupees 1000, and 10% interest. Say if it was per annum, then 1100 rupees. That means 10% rate of interest 100 rupees plus principal money 1000. That means at the end of 1 year, the investor will be eligible to get his entire money, that means principal money plus interest thereupon, of rupees 1100. Now if he will withdraw that particular money from that institution after that period, so that entire period is basically regarded as maturity period, because the investor is eligible to withdraw his principal plus interest thereupon. Both the figures are withdrawn by the investor. So that period within which the investor is eligible to withdraw his principal money, at the same time he is eligible to withdraw the interest money, then that period will be specified as maturity period. Now let us come to our main point. What is the meaning of a money market? Now money market is basically that component of financial market which deals with the short term securities having a maturity period of less than 1 year period. That means it is 100% clear that whatever instruments, whatever securities, whatever assets, financial assets which are traded in the money market, they are having a maturity period of less than 1 year. That means all the investments which are made by the investors in the money market or in the instruments which are traded in the money market, they are having a maturity period of 1 year or less than 1 year period. That means the entire amount of investment, that means the principal money plus the interest thereupon upon all such securities will get matured within a period of 1 year or less than 1 year. So all the instruments, all the financial assets or all the financial securities which are traded under money market, those are basically of short term nature. They are having a maturity period of less than 1 year period. But let me clarify one point here. This definition of money market, which says that all the instruments traded under money market, they are having a maturity period of less than 1 year, it is basically conceptual in nature. It has been given by the experts merely to understand the concept of money market and to differentiate it from the capital market. But in reality, in practicality, or in real terms, when you will go to the market, there are large number of instruments, or you can say there are many instruments, there are many financial instruments which are traded under the money market and they are having a maturity period of more than 1 year period. For example, CDs are there. That means certificate of deposits which are issued by the commercial banks. In the same manner, CPs are there, the commercial papers, they are issued by the reputed companies. In the same manner, treasury bills are there. In the same manner, there are certain commercial bills, there are government securities. All these instruments are traded in our money market, but many of these instruments are having a maturity period of more than 1 year period. But then also, all these instruments are regarded as money market instruments. So, what I mean to say that this definition is basically conceptual in nature, and according to this definition, money market instruments or this particular market deals with such instruments which are having an maturity period of less than 1 year period. So these instruments, the few instruments which are having a maturity period of more than 1 year, they are basically exceptional in nature. They are regarded as exceptional securities which are traded under the money market. So according to definition, money market is that market which deals with short-term securities which are having a maturity period of less than 1 year. Now, on the basis of maturity, it is clear that all the securities may be broadly classified, or they are termed as short-term instruments in our money market. Now, money market is extremely helpful for the government and other institutions, for example, companies and etc., so as to meet their liquidity requirements, so as to meet their short-term funds. Basically, all such kind of organizations, they take the help of money market in order to maintain their liquidity position. Now, as compared to the capital market, this market, that means money market, is less risky in nature. Now, in finance, we know that the risk and return both are basically directly concerned with each other. They are related with each other. And since I am saying that money market as compared to the capital market, it is quite less risky, that also means the instruments or the financial assets which are traded under money market, they carry basically less amount of interest rates upon them. As compared to the capital market instruments, the rate of interest upon the money market instruments, they are quite less. So it is also less risky. Now, let us understand about the concept of capital market. Now, capital market is basically that segment of the financial market which deals with the long-term securities which are having a maturity period of more than 1 year. So, in capital market, all the securities, all the financial assets or all the financial instruments which are traded, they are having a maturity period of more than 1 year. That means once the securities are offered in the market, they are going to be matured after a period of at least 1 year, one or more than 1 year. So the initial segmentation of the financial market was in two segments, that is money market and capital market. So money market deals with the short-term securities in the same manner. Capital market basically deals with the long-term securities. Now, the capital market is further divided into two major segments. The capital market, which basically deals with long-term securities, it is again divided into two major segments, and those two segments are, number one is primary market and second one is secondary market. Now let us discuss regarding primary market and secondary market. Now one thing is very clear, because primary market and capital market both are internal component of the capital market, which basically deals with long-term securities. So it is absolutely clear that whether it is primary market or it is capital market, both the markets deals with basically long-term securities. Now let us understand the concept of primary market and let us discuss regarding the concept of secondary markets. Now, primary market, what is the meaning of a primary market? Primary market is that segment of capital market where the long-term securities are issued for the first time. That means these securities are offered by the companies or they are offered by the government or any other bodies for the first time in the market. So this market, that means primary market, is also popularly known as new issue market. Why? Because all the securities which are offered by the organizations, they are entirely new securities. They are entirely fresh securities. So this security is also known as, or this market is also known as, that means the primary market is also popularly known as new issue market or IPO's market or FPO's market or fresh capital market. Now, it is called as new issue market because the entire securities are new. It is called as fresh market or fresh capital market, because fresh capital is basically generated by the companies or by the issuing organizations. Fresh capital is generated. Fresh securities are basically offered in the market. It is also called as IPOs market. That means initial public offerings market. Why? Because the shares or the long-term securities are offered for the first time. They are initially offered by the companies in the market. In this particular market, the shares are floated initially. They are offered for the first time. It is also called as FPOs market or follow-on public offerings market or further public offerings market. Now, there is a slight difference between IPO and FPO. Let me explain this particular concept. Now, let me explain this concept with the help of an example. Now, suppose there is a company, ABC Limited. Now, that particular company has 100 securities, 100 shares, you can say. Now, whether the company is going to float entire 100 securities in the market at a single point of time? No. It depends upon the company. It depends upon the requirements of the company. What is the requirement of the company? Depending upon its requirement, the company will float the number of securities. Now, suppose the company, the total number of securities which are basically with the ABC Limited or that particular company is total 100 shares. Now, for the first time, the company decided to float 20 securities in the market. Now, when the company will float the first 20 securities in the market, this particular issue will be regarded as IPO, because these securities are offered for the first time. They are initially offered by the companies in the market or primary market. So it is known as IPOs market, because these securities are offered to the general public for the first time. But now, out of 100, the company has decided to float 20 securities. But whether the company has float all the securities? No. The company still have such kind of securities. That means the company still have 80 fresh securities of the same kind. 20 securities have been offered in the market, but the same nature of the securities, that means 80 securities are still with the companies. What about those 80 securities? Whether all those 80 securities are old securities or they are not fresh securities? No, all those 80 securities are still new securities, because they have not been offered by the company in the market. They are still fresh, they are still new securities. But now, suppose a condition in a future when the company decide to float further securities, or out of those 80 remaining securities, the company decided to float say 50 more securities in the market. Now, when the securities will be offered for the second time or for the third time, but those securities are fresh, those securities are completely new, but they are not initially issued. Now, since they are later on issued or they are since they are further issued by the companies, so those fresh securities are regarded as FPOs or follow-on public offerings or further public offerings. So, IPOs and FPOs basically indicates the fresh securities. All the securities which are offered under IPO or whether it is offered under FPO, all the securities are completely fresh, they are completely new securities. IPO basically reflect when the company is offering the securities for the first time, initially. When the company will offer the securities later on or further, it will be regarded as FPO. So, the primary market basically it is a market or it is a segment of capital market where the long-term securities are issued for the first time. So, it is popularly known as new issue market or IPOs market or FPO market. Now, in the primary market, it determines the initial prices of the securities. The companies used to decide or they used to set the prices of the securities for the first time in the primary market itself. Whenever a company decides to float its securities in the primary market, the first and the most important thing which it has to decide is regarding the pricing of the securities, and pricing of securities is done in the primary market itself. Now, the securities which are offered in the primary market that may be floated in or with the help of different methods. There are specific guidelines which are framed by SEBI in order to float the securities in the primary market. Some of the important methods through which the companies can float their securities in the primary market are public issues, rights issues, and private placements. There is also one issue, that is bonus issue, but since the bonus issues, they do not generate fresh capital for the companies in the primary market, that's why that method is basically eliminated from the issue or issue management. So the three most important methods which are used by the companies in order to float their IPOs or FPOs in the market, those are public issue, rights issue, and private placement. Now, let us understand regarding the second concept, or the concept of secondary markets. Now, secondary markets are also popularly known as stock markets. Now, secondary markets or stock markets, they are basically a kind of recognized bodies which provides a platform for the trading of second-hand listed securities. Now, let us discuss regarding this particular point. Why it is regarded as a recognized place? Because in India, when we discuss regarding our country, in India, all the stock markets, if it is a stock market, then it is compulsory for the stock market to get itself registered as per the provisions of SCRA 1956. That means Securities Contract Regulations Act 1956. Only after taking permission, or whenever SCRA Act will grant recognition to any company, then only that particular company or that particular organization can act as a stock market in our country. Otherwise, no company or no body or no organization can act as a stock market, or it can function as a stock market in our country. That means recognition must be granted as per the provisions of Securities Contract Regulations Act 1956. So, stock markets, they are basically a recognized bodies. They are well recognized by SCRA Act. At the same time, they are recognized by SEBI Act 1992. Now, the stock markets, they basically provides a platform where both the buyers and the sellers of the securities, they can interact with each other. Let me clarify one thing. Stock markets, they basically deals with long-term securities only, because they are internal segment of capital market where only long-term segment securities are being traded. Now, on the capital markets or on the stock markets, the long-term securities are issued, but these securities are not fresh securities, because fresh securities were initially issued in the primary market itself. Now, stock markets, it basically deals with the second hand or listed securities. Why these securities are called as second hand? Because initially they were offered in the primary market. Initially, the fresh securities were issued in the primary market, and once a security fulfills all the terms and conditions prescribed by the primary market or prescribed by the SEBI, and it basically passes all the norms which are prescribed by SEBI for the primary market, then those securities are eligible for the purpose of listing over the stock markets. And since the securities are not fresh, they were fresh when they were issued in the primary market, but once they were issued, once they were subscribed by the investors, then those securities becomes old securities. They are not fresh securities. Now, when they are eligible for the purpose of listing, they comes to the stock market. Now, let me clarify one thing here, that listing is not compulsory in the stock markets. That means it depends upon the company. It depends whether the company is requiring listing, it wants to list its securities, or it is not opting for listing. But it is 100% clear that if a company has to trade its securities over the stock market, then it has to go for listing. Now, let me clarify this point once again. When a company will enter the primary market, then the company will raise money, the company will collect money. Now, after the successful completion of the primary market, it depends upon the company whether the company is going for listing or it is not going for listing. That means if a company is going for listing, then it can trade over the stock markets. But if the companies do not want to list its securities over the stock market, then it can withdraw its money from the primary market itself. So in the secondary market, listing is not compulsory. But if a company has to trade its securities in the secondary market or in the stock market, then it is compulsory for the companies to get their securities listed over the stock markets. Now, in the next video, I will discuss regarding the important components of the money market, that is organized and unorganized sector. Now, that particular video will cover 8 major points. Those points are the meaning of money market. That means what is the exact meaning, how we can define about the money market. Then what are the features of a developed money market? That means what are the important features which must be seen in any money market in order to be regarded or in order to regard that particular market as a developed money market. The third segment is what are the important features of Indian money market. What are the features which can be seen in Indian money market? The fourth segment is what are the important segments of Indian money market or how it can be broadly classified under various components. The fifth important component is what is the meaning of organized sector. In the later part, we will discuss regarding the major participant of the organized sector. In the seventh segment, we will discuss regarding the meaning and definition of the unorganized sector. And in the last segment, we will discuss regarding the major participant of the unorganized sector of the money market. So, thank you for watching this video.